Hi, I'm Wayne Zell. I'm an estate planning and business planning attorney. I'm discussing the basics of business planning. And now I'd like to cover charitable planning for you as an individual and your business. You must have an intent to donate assets permanently to charity to engage in charitable planning. You can restore the assets that you give away to charity by using life insurance, and there are various techniques that we use as estate planners to accomplish that. The common techniques for charitable planning include the very basic charitable donation. In a charitable donation, you're going to give assets directly to a public charity, a 501c3 organization formed under the Internal Revenue Code. You can also give your assets to a donor-advised fund. This is a fund that's formed solely for the purpose of distributing assets that donors give to charity. These are quite popular, but there's limited control. You can also give your assets to something called a private foundation. There's more control here if you set up your own private foundation, but there's a lot more regulation. Another technique that we've used successfully for charitable giving is something called the Charitable Remainder Trust. The concept is to give away appreciated assets today. If you do that, you might get a current charitable income tax deduction, and you also get an estate and gift tax deduction for charitable purposes as well. The Charitable Remainder Trust pays you, as the donor, an annuity or a flat unitrust amount of at least 5% a year for your life, or for 2 lives, or for a set term. The key in this arrangement is that you have to leave something for charity at the end of the term of the trust. Also, annual payments out of the trust cannot exceed a maximum annuity of 50%. If you set up a charitable remainder trust, the entire amount of the remainder interest that goes to charity is excluded from your estate for death tax purposes. And here's another benefit. If the trust sells the appreciated assets, there's no capital gain on the sale of the asset. You're only taxed when you receive your annuity or your unitrust amount from the trust on an annual basis. Charitable remainder unitrusts work best when interest rates are low, so remember that. And charitable remainder annuity trusts work best when interest rates increase. Charitable remainder trusts are really useful when capital gains rates are very different from ordinary income tax rates. Another technique that we use for our estate planning clients and for business planning clients is the charitable lead trust. In this type of a trust, you make a contribution to a trust for the benefit of a charity for a set term. Usually it's 15 years or more. At the end of the term, the remainder of the trust, instead of going to charity, goes to your heirs or a trust for their benefit. There's a twist on the charitable lead trust known as the testamentary charitable lead annuity trust and charitable lead unitrust. These are used for really high net worth taxpayers and can be very useful in zeroing out death tax in a very high net worth situation. In a charitable lead trust, unlike a charitable remainder trust, the donor does not get a charitable deduction unless the trust is structured to have you, as the donor, pay tax on the income from the trust. Either in the case of a charitable lead trust or a charitable remainder trust, you can replace the wealth that was given to charity by purchasing life insurance with the tax savings that were generated by the charitable deduction, in the case of the charitable remainder trust, and the deferral of income tax on trust earnings that you may have achieved by forming this type of entity. I hope this information will help provide you with a better understanding of what is needed to begin your business planning and your estate planning. Best of luck to you.